Hi, I'm Jennifer Folsom, the Chief of Corporate Development here at Summit Consulting, and this is Complexity Simplified. I'm here today with Dr. Eddie Seiler, our Chief Housing Economist, to talk about interest-only mortgages. Welcome, Eddie.
Thank you.
So, what is an interest-only mortgage? It sounds interesting.
It is. So in a regular mortgage, when we usually take a loan, we can think of two components of the payment. So if somebody takes a loan out, for instance, for $200,000, they want to pay that $200,000 down over time.
Sure.
And so they pay a principal payment in addition to the interest payment. In an interest-only payment, the $200,000 stays constant. The principal isn't touched, and the only part of the payment made is on the interest. So the payment is smaller than in a regular mortgage.
So is that why people get them? Because the payment's smaller?
Yes, exactly. So like every kind of product that's out there, there's a reason. So a lot of people may be wanting to start in a house, and they may think their income over time will increase. So if they take an interest-only...
We'd all like to hope for that.
Right. So in an interest-only mortgage, over the first period of time, when only the interest is paid, the payment is less than in the future. Now, the catch is, of course, that in the years after the interest-only period is finished, then there's an accelerated payment on the principal, or perhaps even a balloon payment, a large payment of the principal at some certain times. So if somebody believes their income will increase over time, then it may be a good product for them. They can buy more house at the current period.
And maybe if they thought the house value might go up.
Exactly.
Right?
Exactly. That's one of the pitfalls of an interest-only mortgage. So in the long run, if you have a regular mortgage and you pay your principal down, even if house prices don't increase, you're building equity in the home. However, with a principal where you're not paying principal, in an interest-only mortgage where you're not paying any principal, if house prices don't increase, you're not increasing the amount of equity you have. And if house prices depreciate, then your equity may shrink to zero very quickly.
And don't I remember hearing a lot about interest-only mortgages in the news around the time of the big housing crisis and the financial bubble bursting?
Yes, exactly. So, as I said, there's a great reason why people may want to take an interest-only mortgage. However, you can think of more sophisticated consumers who are thinking about future income rises or thinking about potential house price increases in the area. Yet, during the crisis, or prior to the crisis, a lot of banks pushed interest-only mortgages on consumers, and they were trapped in these mortgages. And why do I say trapped? Because it's not only that increase in payment that we talked about before, because a lot of interest-only mortgages are interest-only for the first 5 or 10 years. They also were sold ARMs, adjustable rate mortgages. So as interest rates increase now in the future, the payments will go up not only because of accelerated principal payments, but also because of larger interest rates. It could be a double whammy.
That's quite a double whammy.
Right.
Well, thank you, Eddie. I learned a lot about interest-only mortgages here.
Thank you, Jen.
Please join us for the next Complexity Simplified.